We're waiting. Without much further ado, we will begin with today's webinar. Over the past 1.5 weeks, there have been uh, quite a lot of red seen in the equity markets. And this is a problem that, well, interestingly, although it's blamed on LTCG, is not exactly due to the LTCG. What the exact reason is, we will be discussing in today's webinar. First of all, a very good morning and thank you so much for joining on the Saturday first webinar. My name is Sudarshan, and in today's webinar, we will be looking at the Indian economy first, and then we will be looking at the global economy, the reason as to why the stock markets have been correcting recently, and then we will look at the investment strategy on this basis. We begin with India. When we look at some of the parameters in terms of economic performance of India per se for the month of January and for December, they've been positive. Uh, Economic activity, which is measured through PMI, as can be seen on the right side of the table, are have a reading above 50, and a reading above 50 means an expansion in economic activity. The services, which is the biggest contributor of the Indian economy's GDP, is seen growing in the month of January after remaining flat in the month of November. This shows that the structural and disruptive changes that were introduced over the past financial year are slowly wearing off, and the effects are seen in the long-term growth. Similarly, manufacturing is also on a positive note, and the overall composite PMI, which is a measure of both the manufacturing and services activity, is positive. But one of the biggest concerns that India has at the moment is the inflation. As can be seen on the left side of the screen, the inflation as measured by CPI is at a very high 5.21%. These levels of inflation were not seen since 2014. And the WPI inflation is at 3.58%, which is still comfortable, though although slightly on a higher side. The Reserve Bank of India, which has taken up a policy of fixing the inflation, would like to keep the inflation at about 4%, plus or minus 2%. Looking at these inflation numbers, it seems that inflation is contained within limits. However, there is still a risk of the inflation actually going up because of a couple of factors. We have the oil, which is the largest, which has the largest share of India's imports. The oil prices are going up, and we've also seen the rupee value correcting a little bit over the past month. Other than this, we also have a few measures that were introduced in the budget, which could potentially increase the inflation. Heading straight into the topic of the equity markets. So over the past month and a half, not counting the last 1.5 weeks, the equity markets have been rallying, as can be seen on the right side of the screen. Nifty had grown to an all-time high. It had crossed 11,000 mark. And there are a lot of positive global cues which are supporting this growth. The corporate earnings, which were reported in the month of December, they also showed increase. All of these had helped the Nifty rally to high. But slowly, the Nifty found rallying further a bit more difficult. So there were global sell-offs that happened towards the fag end of January. But there was one event that sort of triggered a downfall in India, or it would seem as the trigger that, or it would seem as a trigger that led to the downfall of the equity markets. And this was the finance minister announcing the introduction of LTCG in equity. LTCG is long-term capital gains tax, and this is typically calculated for gains that are made on equity investments after a period of 1 year of investment. Now, the LTCG is the market's correction due to LTCG is primarily more of a knee-jerk reaction, but it is not the causative factor for the markets correcting at the moment. Just to put it in perspective, uh, most of the most of the trading that most of the investments in India that happen in equities are in the form of trading. That is, they're more of short-term buys and sells. So these attract more of short-term capital gains tax rather than the long-term capital gains. So when investors withdraw money due to the interest of LTCG, it is more of uh, uh, a negative reaction rather than a permanent effect on the stock markets. So, what the real reason is for the correction in the global markets, we will get to the subsequent slide. But right now, we'll address one more event that happened over the past 1.5 weeks, which is the budget. We'll talk specifically about how the budget will affect uh, the uh, 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 the measures introduced in the budget, which could potentially have an effect on your taxes. As can be seen over here, there are about five key points that affect the direct taxes. So there is a proposal to introduce the health and education cess from 3% to about 4%. The increase of 3 to 4% will only it's only marginal in terms of the actual rate of a tax which you'll be paying. So, for example, if you are a person who falls in the 30% bracket, that is your net taxable income is above 10 lakhs, then the amount of tax that you would be paying is 30% plus 4%, which is 31.2% in this case. Earlier, this was 30.9%. This is more of a marginal increase in your taxes. But another measure introduced towards this end is there's a standard deduction of about 40,000 rupees from salaried employees. This specifically will affect salaried employees only and not independent business owners. And similarly, there is about a 50% additional benefit that has been provided to senior citizens in the form of Mediclaim. Overall, the net tax which you will be paying towards income tax, uh, assuming that you have the same income for this year as well as the previous year, it would be more or less similar, if not exactly the same. There will be a marginal increase only in the total amount of tax which you pay. And towards helping the corporate India to increase its business, the budget this time is focused specifically on MSMEs, that is, companies which have a turnover of up to 250 crores. Towards boosting MSMEs, which are the largest employers in India, uh, the government has proposed to reduce the corporate tax to 25%. So these companies have a much better chance of survivability as well as a higher chance of employing uh, increasing employment opportunities. When we look at the European Union and the United Kingdom, uh, the EU and the UK also are looking at inflation as one of the key factors in driving the monetary policies in the recent times. The inflation in the European Union for the month of December 2017 stood at 1.4%, whereas the UK it was about 3.1%. An inflation of the developed economies would prefer an inflation of over 2%. So the UK is comfortably in a position to actually raise interest rates. So, in a recent statement made by the Bank of England, this was reflected. The Bank of England suggests uh, made statements which hinted at an increase in the interest rates in the coming months. The European Union also was expected to raise interest rates, considering the very strong amount of growth seen in the economy. This can be seen in the PMI on the right side of the table. However, the head of the European Central Bank tried to dismiss these rumors, although it was suggested that the buying of the bonds would be actually be tapering off. But for now, the European Central Bank is keeping its interest rates fixed at a near 0%. Look at the other major developed economy, which specifically is in Asia. We look at Japan. Now, the Japanese stock exchange Nikkei 225 has corrected by the most in most of the Asian indices, and the correction in Asian indices coincidentally started in the February 1st, 2018, which is also the day in which our budget was presented. This is the first point which we would cite to prove that it is not the LTCG which is causing the downfall of our stock indices, but it's actually much more global macro factor. In since the first week of Feb, Asian stock indices had experienced a weakness. And some of the biggest sell-offs in the Asian indices happened in Japanese Nikkei, Korea's Kopsi, and China and India. So more of global factors are driving down the stock indices rather than rather than the introduction of LTCG. But if you look at the performance of the Japanese economy through other measures, if you look at the PMI, as can be seen on the right side, and services is expanding, and the services constitutes about 60% of Japan's economy. And when you have positive service expansion growth, it suggests that the Japanese economy is stabilizing now. But what is more important for the Bank of Japan and the government of Japan is the inflation rate. The CPI of Japan for December 17 stood at 1%, whereas the core inflation stood at 0.9%. Interestingly, the unemployment rate, which was steadily declining through most of last year, stood at a multi-decade low of 2.7%. But in December 2017, it picked up marginally to about 2.8%. Manufacturing activity in Japan has been picking up quite rapidly, and the Japanese economy is quite export dependent. So, the weakening of the yen in the global markets, which was the intention of the Bank of Japan as well as the government of Japan, is quite a big factor in improving the manufacturing and export activity. Because the weakening of the Japanese yen will mean that Japanese products will be much more cheaply available in the global markets compared to a much more stronger yen. And now we look at the economy that has caused the trigger of the downfall in the global stock indices. We look at the economy of the United States. In terms of the economic performance, as can be seen by the PMI on the right side of the screen, the US economy is strong, it's very stable. And this was observed even by the Federal Reserve in its last policy meet. The inflation is also over the 2% mark, uh, which is where most of the developed economies would like to keep it. So these factors have prompted, will prompt the Federal Reserve to raise interest rates in the coming year. There have been indications that the Federal Reserve might interest rates three times this year instead of two. But surprisingly, it did not raise interest rates in this current policy meet. Now, owing to the rising inflation, one of the factors that has to be considered the uh, is the yield of the government bonds. With the rising inflation, the Federal Reserve will be expected to raise its interest rates. And when the Federal Reserve raises interest rates, the yield of treasury bonds will also rise. Which is why towards the end of January, U.S. Treasury bonds gave a yield of about 2.88%. By Indian standards, it may not be much, but it is quite high by US standards, because this high yield of 2.88% was last seen in 2014. So when this happens, um, bonds become more attractive. So there is a little bit of money that is taken out from equity markets and invested in bonds. Now, in the world economy, the U.S. economy is considered to be the most stable, because of its economic prowess and its capacity. So, when the U.S. Government bonds has emerged, was shown to give a yield of about 2.88%, you would have money taken out from less reliable economies like the developed economies, such as the developing economies, such as the Asian economies, and they would be invested more in the United States. Which is why, if you see, in the past couple of weeks, there have been foreign FII outflows to the tune of over 1,500 crores. And these have been taken and invested in the United States. Now there is a different there's also a different problem that occurs in this particular situation, and this is we believe the main trigger for the reason of the downfall across the world markets. In the last decade or more, what has been boosting the stock markets is actually the easier availability of credit from the central banks. When the central banks maintained very low interest rates, like the Bank of Japan maintains negative interest rates, the European central banks maintains a zero interest rate, and the U.S. Federal Reserve had maintained an interest rate of just 0.25% for almost a decade. Now, this easy availability of credit is what fueled the growth in the developed economies. When inflation rises, uh, the central banks of each of these economies will be prompted to raise their interest rates. And when they raise interest rates, the availability of credit declines in the economy. And with the declining availability of credit, the ability of companies to invest will also decline a little bit. Additionally, in the previous in the month of December, some of the big US companies, including Alphabet Group, which owns Google, and Apple, had reported a marginal decline in earnings. Now, with the prospect of the Federal Reserve uh, raising interest rates, the profitability of these companies also becomes a bit more difficult, which meant that it would be much more safer to invest in a stable yielding instrument such as a bond versus an equity. So there resulted in a decline in the equity markets starting in the US. And this sentiment was reflected across the world, and which is why the world markets are currently in the process of correction. There have been numerous reports, including Indian indices, talking about how the stock markets are actually overvalued and overheated. So this sort of a correction is actually more beneficial for the longer term, even though it is a pain in the shorter term. Because a correction in this term would mean that the companies, the stock markets would begin to trade at par or at value, rather than being over invested at the moment. When we look at the emerging economies, specifically in Asia Pacific, we look at China. China is the dominant economy in the Asia Pacific region. Now, the Chinese stock indices also had corrected by quite a bit. While the Indian stock indices have corrected about 5 to 6%, the Chinese stock indices have corrected to the tune of about 10%. So India is still relatively much better off compared to the rest of the world, and this is despite the introduction of the LTCG. But if you look at the economic performance of the Chinese and the Asia Pacific economies, meaning Asia, we see that as measured by the PMI, the Chinese economy is expanding and services have picked up quite rapidly. Manufacturing is a bit tepid. And the composite PMI overall of China is comfortably above the 50 mark, meaning it is expanding at a quite comfortable rate. The Asian's manufacturing PMI, which had seen a reading of less than 50, which means a decline in December, was once again in the green for the month of January 2018. One of the biggest beneficiaries of the commodity rise in the world economy currently at the moment are the Latin American economies, owing to their dependence on the export of commodities. Brazil, which is the largest economy in the region, has seen slowly expanding out of a sluggish growth. The services PMI for Brazil for the month of December was at 47.4, which meant a very rapid decline. But for the month of January 18, it was neither growing nor falling. It was at a flat 50.0. However, manufacturing has picked up in Brazil. So overall, the Brazilian economy is expanding. It was about 1 year ago that the Brazilian economy was able to come out of its worst recession in history. While it has not been able to sustain comfortable growth, it is slowly on the path. Brazil will be heading towards elections shortly, and the outcome of these elections will determine the future policy that the economy of Brazil will be adopting. But as discussed in our previous webinar, the Latin American economies are slowly shifting from a leftist government towards a rightist government. So we can expect more of investments to be picking up in the Latin American economies. So the outcome of Brazil can be expected to be favoring a much more right-leaning candidate as well. When you look at the commodities, two of the biggest commodities that India imports is oil and gold. Oil is the biggest constituent of India's import basket. And over the past half of the previous year, we've seen rapid growth in the oil markets, owing to persistent production cuts by OPEC and the Russia alliance, as well as declining inventory levels in the United States. So prices breached the $65 mark on 25th Jan. This was last seen in December 2014. And since then, the oil markets have seen limited upside. The oil market saw a decline after reports of the US's increase in crude oil stockpiles in 6th February onwards. So this will keep the oil markets range bound. We will talk more on the implications of this in the subsequent slide. Moving on to the next commodity, we look at gold. Gold has been reacting largely to the geopolitical situations between the United States through the host of last year. With the election of President Trump, there has been more and more policy uncertainty. Uh, More recently, we had the elections in Alabama, which is traditionally a Republican stronghold, but it was won by a Democrat this time. And because of this, in the U.S. House of Representatives, where the policies, which is the equivalent of the Rajya Sabha in India, uh, there is there is a higher resistance. There's higher representation of Democrats. So President Trump, who is a Republican, will find it much more difficult to pass policies. Now, owing to the geopolitical tensions, geopolitical uncertainties, being from the United States, uh, gold and dollar, which have an inverse value, um, gold has been declining. Gold has been increasing due to the weakening of the U.S. dollar. Uh, the U.S. Treasury Secretary had recently commented that he is welcoming the weakening of the U.S. dollar in the global global trade of currencies. Because as we discussed in the section on Japan, a weak currency would actually help exports. So a weakening of dollar will also help the the U.S. economy export much better. Now, a weakening dollar will imply a strengthening of gold. When we look at how all of these factors affect you, as we had discussed in the oil section, the fuel prices are declining. But over the past 2.5 weeks or so, the rupee has been strengthening, has also been weakening. So what was the rupee was trading at about 63 and a half rupees to the dollar is now closer to the 64.3 mark over a period of 1 month, which means that importing by India will become much more costlier for it. And with the oil markets, although they are marginally declining, uh, will keep the fuel prices within limits. We may not expect much of a rise in fuel prices, but neither will there be much of a fall in the fuel prices either. It will be more or less maintained as it is right now. Gold, which we saw previously, was in the previous slide, was strengthening due to the weakening dollar. Now there is much more scope for the dollar to weaken, considering how the U.S. Government is the process of a shutdown due to a budget deficit. Now, until the U.S. government approves of a budgeting policy to finance the government will stay in a shutdown, which means that the US dollar will continue to weaken. And with the weakening of the US dollar, the gold prices will increase. There are quite a few policies that were introduced over the past month and a half, specifically within the Indian economy, through in the form of the budget. In the budget, there was a proposal to increase the custom duty on mobiles from 15% to 20%, and some mobile and TV parts to about 15%. While uh, there have been comments that this is seen as more protectionist, but this will actually make imported electronic goods much more costly and much more and Indian made electronic goods much more attractive to buy, much more affordable per se. The One of the proposals in the budget was to raise the minimum support price to about 1.5 times production cost of about 43 different crops. This will have a slight effect on the food basket of the Indian consumer. So there will be a slight increase in the price of vegetables in the entire year, depending on the fluctuations. Now, with the introduction of LTCG, the actual earnings which you start to gain from equity investments would be marginally lower, at about 10% of the overall gains which you make over a profit of 10 lakhs, over a profit of 1 lakh. Sorry for that. And the income tax slabs, as we had discussed earlier, have been more or less left unchanged. But there is an introduction of 40,000 rupees standard deduction and a slight increase in the form of a cess, which was previously 3% and now 4%. This will have a very limited effect on the amount of tax that you will actually be paying. When this affects your personal finances, this also should affect the way in which the investment should be carried out. So, if you look at the global uh, volatility, it will continue to persist in the short term, or the markets are still overheated in some of the economies, including India. So there is still a bit more room for correction before the markets can trade at par. So while it is in the decline, it is still good to stay invested because over over the medium to long term, equity markets will definitely rally. So as we had discussed in the section of India regarding the PMI, we had seen that the structural changes introduced in the Indian economy in the previous quarter are starting to show effects. Now, these effects will become much and more profound in the coming financial year. So we can expect the equity markets to rally during this. We can expect the equity markets to rally during the medium to long duration. So it is best to stay invested. And when the markets are declining, some of the stocks will be available at a much more cheaper price. So it is good. It is also a good strategy to buy during a decline in the market. Now, in the budget, one of the proposals of the government was to increase the borrowings, which means that the government of India will issue more bonds. Now, with the issual of more bonds, the yield of the government of India bonds will increase. Additionally, with the inflation also rising, the the RBI would be looking to raise the interest rates as well. So the yield of a government bond will be set to increase further. Now, the yield and the price of a bond are inversely related. So if the bond yield rises, the bond prices decline. So in the immediate term, we can still expect bond prices to decline, bond markets to decline, but then the lower prices and the higher yields will make them much more attractive. So we can expect bond markets to rally within similar to how the equity markets will be rallying. So it is best to stay invested in bonds of medium duration. Gold is an instrument that shines best during volatility. And with the volatility continuing in the global markets and further volatility expected in the from the United States, gold will be expected to rally a bit more, or to strengthen a bit more. While we do say that gold is expected to strengthen, we would not recommend gold as a form of investment. Gold should be as a form of hedge. So for those who have invested in gold uh, in their portfolio and invested in equity also in their portfolio, would have seen lesser losses in their portfolio compared to those who did not buy gold. So gold is good to keep as a hedge. So keeping gold at about 5 to 10% of your portfolio would be a good strategy. With this, we reach the end of our webinar. We are now open to questions. Thank you so much for joining us on our webinar today. If you do have any questions, please feel free to reach out to us at research@arthayantra.com. We'd be happy to help you on answering any queries regarding regarding your portfolio or macroeconomics. Thank you. Have a nice day.